Hey everybody, Corbin from Remax Treeland here. With our last video, we discussed why you definitely want to get pre-approved before you go search for a home. But in this video, we're going to dive a little deeper and tell you exactly how your bank or mortgage broker determines the exact amount that you qualify for. Simply put, a lender looks at three things to determine exactly what your pre-approval is. First off is your credit score. A lot of people may have heard of this, but not everybody knows exactly what it is. Your credit score is a measure of your financial health. This is what lenders use to determine the risk factor when lending to you. If your credit score is between 680 and 900, you'll qualify for what's called an A lender, such as a major bank or credit union. These lenders offer the lowest rates. If your credit score is between 600 and 680, then an A lender is much less likely to lend to you. It's not impossible, but it's less likely. If your credit score is below 600, then you'll qualify for what's called a B lender. B lenders have higher interest rates. The second thing a lender looks at is your down payment. Your down payment is the lump sum of money that you put down towards your mortgage. In Canada, the minimum down payment is 5%. If you put less than 20% down, however, you'll have to purchase what's called mortgage insurance. The size of your down payment affects how much you can borrow. For example, if you're buying a home worth $300,000, you'd have to put $15,000 as your down payment. However, if you're purchasing a home over $500,000, then your down payment requirement goes up. For example, on the first $500,000 of your purchase price, you have to put down 5%. On the remaining amount, you have to put down 10% up to $1 million max. A house worth $600,000 would require a down payment of at least $35,000. The third thing a lender looks at is your debt service ratios. Your debt service ratios are essentially based on two things: your monthly income and then your monthly expenses plus whatever debt that you owe. Lenders use these ratios to make sure you can afford your monthly payments. In order for a lender to pre-approve you, you're going to need some supporting documentation. Depending on the lender or mortgage broker that you sit down with, this documentation may vary. Here's a list of documentation that you may need to provide. Identification, proof of income, length of time with an employer, proof of down payment and ability to pay the closing costs, proof of any other assets like a car, cottage, or a boat, information about other debts including credit cards or line of credits, spousal or child support payments, student loans, car leases, or personal loans. So as you can see, there's a lot of factors involved when determining your pre-approval. Our best advice is simply to call your mortgage broker or call your bank and get this process started as soon as possible. And if you need help getting a pre-approval, give us a call and we can get you pre-approved today.